On this channel, I bring you active funds that might be less volatile than a global tracker, or they might be able to outperform a global tracker. And in this video, I'm bringing you a fund that might be able to do both of these things. The Argonaut Flexible Fund calls itself a hedge fund long book. And by that, it means that it takes short-term positions in themes that it thinks will do well. And then it also balances that against potential exposure to commodities and bonds. And that's to reduce the volatility of the fund. It generally takes high conviction positions. So maybe it has 30 to 50 equity positions at any one time. It doesn't use leverage, it doesn't use any short selling, and it's really kind of best ideas, and it's completely style agnostic, so it doesn't follow any particular index. It's a new fund, it's been around for less than a year, but you can see in this price chart when there was the Trump tariffs, the fund fell by less than a global tracker, and then since then it's been able to outperform a global tracker. Here's an overview of some of the themes it's currently invested in. Gold miners at number 1, tankers, which is presumably shipping companies, number 2, something called idiosyncratic recovery at number 4, and then even more bizarrely, salmon, which must mean companies that produce salmon, at number 6. Then it's got 90% equity exposure, a little bit of commodities exposure, and then a bit of cash on hand as well. And then it's going to switch out of these themes when they no longer have price momentum. So rather than being a gold dominated fund all the time, it just moves into gold when it thinks there are opportunities there, and then moves out when it thinks the opportunities have gone. And for that reason, it might be able to beat a global tracker over time. And here's the exposure in terms of regions, industries, top 5 equity positions, and top 5 non-equity positions. Here's some stats for the Argonaut Flexible Fund that show its correlation with a global tracker, which it's saying is 0.2, the Sharpe ratio, which is like returns relative to the volatility, the standard deviation of those returns, which is over 2, and then the maximum drawdown, where here it's about 9% compared to 18% for a global tracker. So some pretty impressive stats. This is some of the ethos behind the Argonaut Flexible Fund, and the main point is that flexibility, that it's unconstrained, it's not linked to any particular style considerations such as value or growth, and it can quickly change its positioning if it so wishes. The fund has an annual management charge, AMC, of 0.75%, and it's available in accumulation or income variance. I did a video about funds that had achieved 5% or more growth in the last 5 calendar years. There weren't many of them, but the sister fund of this, the Argonaut Absolute Return Fund, was one of them. That fund does allow short selling, and it does have uncorrelated results compared to a global tracker. However, at times that lack of correlation can mean that the Argonaut Absolute Return Fund is losing money at a time when global trackers are performing strongly. I think for that reason, I'm not always that keen on the Argonaut Absolute Return Fund. A fund that's a little bit similar to the Argonaut Flexible Fund is Orbis Global Balanced, where the equity part of the Orbis fund is really around value equities to lower the volatility. And the performance of the Orbis fund is really just smooth like dream topping. It's a fabulous fund, been around for a long time. So if you want something that's maybe less risky, taking less of a gamble, then I'd look at the Orbis fund, which also featured in my funds that have delivered 5% or more growth in the last 5 calendar years. With investing in retirement, I look at a bucket strategy where you've got a short-term bucket that has capital certainty for things like money market funds, a long-term bucket, 10 years plus into the distance, where you can easily hold a global tracker or even single country funds like India or something like the NASDAQ. And then you've kind of got this tricky middle bucket that's between maybe 3 and 10 years, where you're looking for funds that are robust, that they will have limited drawdowns, they'll rebound quickly, but also have fairly decent performance that is going to beat that of a money market fund. It's the most difficult one to fill up. The Orbis fund does it quite well, and hopefully this Argonaut flexible fund will do it too in the future. I do like funds that offer something truly different, something that a passive fund would in no way attempt to replicate. But you do have to be careful with active funds. You can't put too much of your wealth into a single active fund, and you have to build a proper portfolio and manage your exposures accordingly. Just avoid something that's a load of old arse, like most of the Vanguard stuff. If you want help putting together a portfolio for investing in retirement, then you can look at my portfolio coaching service, or you can check out this next video.